let's get on into it and have some fun, shall we? So today's webinar is going to be on the topic of policies for minors. So IBC Global, Insurance Business Concepts Global, during our webinar today. The main question we often get when it comes to taking a policy out on a minor, we hear this very frequently from individuals who have kids or even grandparents when they're looking at a policy on their grandchild or grandchildren is, I'm older. When I look at a life insurance policy, I know that the younger an individual is, the less it will cost for a certain death benefit. So, being that cash value is my primary point of interest with a whole life insurance policy, can I just take a policy out on my child or my grandchild and just stuff the policy with as much money as possible? Everything I would put into a policy on me, can I just put it into a policy on my kid? The answer is not really, due to limits and such, but we're going to touch on a lot of interesting points during today's webinar, where a lot of times when one actually takes time to look at the numbers and see what a policy actually looks like from a performance standpoint, there's not a huge difference. There are advantages to taking a policy out on a minor, but it's not as drastic as one would think. What I mean when I say that is a policy on a minor versus someone who might be 30 or even 60 years old. So let's hit on a couple bullet points here, shall we? Point number one we want to hit on: will a policy on a child produce greater results than a policy on an adult? And the answer is maybe, maybe not, depends on a couple factors. So it is true that the younger an individual is, the less the actual cost of a life insurance policy is. So if I am just price quoting a policy, meaning you said, hey, I'm in the market for a $1 million life insurance policy. I want to protect my family. In the event that I die, I want $1 million in life insurance, which will be paid out income tax free to go to my family or beneficiaries. What is true about all life insurance policies is if I'm going to look at a policy for a 30-year-old individual or a 60-year-old individual, and all I'm doing is price quoting that, I just plug it into a term insurance system. So I'm going to shop term insurance or even a basic whole life insurance policy. The older I grow, the more expensive that $1 million death benefit will be. We're going to look at examples of this. I'll add this. People we work with, this is never the approach we take, because in my opinion, if I'm interested in a high cash value policy, even a high death benefit policy, what you can do with properly designing a policy, we can often attain a high death benefit and keep our out-of-pocket or premiums low, the insurance expenses low, and really juice the cash value. But again, we're going to look at some visuals on that. So if I'm just price quoting, so you want $1 million and you ask, hey, how much will it cost for a $1 million policy? A 30-year-old might cost $10,000 per year. We'll assume it's a whole life insurance policy. And the 60-year-old individual, put him in red, might cost me $40,000 per year for the same policy. Big, big difference, because the 60-year-old individual is expected to die sooner. Now, if we throw a minor into the equation, the price will be even less, and we're going to look at that. Let's continue on though. If we do this instead, if we take that 30-year-old individual and that 60-year-old individual, and they both pay in the same dollar amount into a policy, so they're each going to pay $10,000 per year into a policy and state, my primary objective is the cash value, not the death benefit. What we can do is design a policy appropriately in a manner where you'll see very, very similar cash values, but much different death benefits. And this would be the case if I'm looking at a policy on a 30 or 60-year-old individual, or if I'm looking at a policy on a 10-year-old individual. Being that the topic of today's webinar is policies on minors, and we're going to compare those three examples. So here's the big thing. If a policy is designed in an identical fashion, the cash value will be similar, but the death benefit will be much different. Let me hit on the design piece here, because this is very important. If you're new to this, when I say design a life insurance policy, that can be confusing to some, because typically when we hear the word insurance, let alone life insurance, just insurance, what comes to mind? Well, I pay something called a premium. I have an insurance benefit. And if something bad happens, in the case of a life insurance policy, if I were to die, well, then that actual life insurance is paid out to my beneficiaries. And we don't want to die. Now, with that said, when we talk about policy design, here's the fun part when it comes to maximizing the cash value. Did you know that if you're going to pay any dollar amount into a life insurance policy, instead of me saying, here's a $1 million policy and it's going to cost you X amount of dollars, you instead can come to me or your agent and say, here's how much money I'd like to pay into a high cash value life insurance policy. When I look at a cash value policy, the core benefits regarding the cash value, in particular whole life here, is that it is a safe, liquid, tax-free area to position money. Safe, liquid, tax-free. Safe, the net internal rate of return will produce between 3 to 5%. Liquid, you can access that money anytime. If you've ever done any research on policy loans, remember that once a dollar passes through the cash value of a life insurance policy, if I just let that dollar sit and grow, let's assume it earns 4% net, it'll earn 4%. If I decide to take a loan against that policy, I continue to earn that 4% on any money in cash value. Think of it as remaining equity that I have not accessed and the money that I borrowed against the policy. So I get that constant compounding. And then tax-free, if I do things properly, meaning I don't trigger a MEC or another taxable event, which we cover in other webinars and such, and you can reach out to us if you have questions on that. So those are the core benefits. And then the name of the game is maximizing the cash value. Often people know the younger I am, the less the internal costs are. So can I take a policy out on a minor to juice that cash value? Here's the policy design. If you've got a policy here, we've got our cash value. And then we've also got our death benefit, the far right. You, the policyholder, can actually choose where your money is going. There we go. So if you're going to pay in, let's call it $10,000 per year, money can go toward this insurance premium. Premium dollars typically produce zero cash value in the first year, sometimes the first and second year. The reason why is because the insurance company is going to overcharge us for the death benefit up front. So we can pay dollars toward the premium piece or toward this PUA, which stands for paid up additions rider. These dollars, guess what? Show up in cash value. This is the key to accelerating the cash value growth on any life insurance policy. So if you're paying $10,000 per year into a policy on your son or daughter, perhaps they're a minor, where would you like to direct that money? Well, in order to maximize the cash value, we want to drive that premium as low as we possibly can based on the insurance company or companies we are considering, and then also the IRS limits. But key here is, going back to the Word document, is that if we want to design a policy for maximum cash value instead of price quoting it. So if we're going to add a zero to that scenario we just looked at, if I'm going to pay $100,000 per year into a policy, or I want the ability to pay $100,000 per year into a policy, what would I do here? You can design a policy with a minimum premium. Going back to that red area, premium dollars do not show up in cash value in the first year. And then I would also want a $100,000 MEC limit. So I can design the policy in an identical fashion for the 10-year-old, for the 30-year-old, and then also for the 60-year-old. Going back to our original question that we often receive, I've got a child or I've got a grandchild. Can I just take a policy out on them because it will be less expensive? The answer is you can take a policy out on them, but it's often not as inexpensive as you would think. And there's some other limits we'll hit on as well. So let's continue on here. Once we reverse this, look at that. I just learned something new today. And if I use the zoom controls here, I'll get the reverse here as well. All right. There we go. So what we're going to look at here is we are going to compare a policy on a 10-year-old individual versus a 30-year-old individual, and then also a 60-year-old individual. This will be fun. Going back to that question, we see it under A here. My child is young. Can I just put a policy or put everything, my total payment, into a policy on them since the costs will be less? We're going to look at one of the major mutual companies, one of my personal favorites in this example, good old Guardian, and we will look at MassMutual later in this webinar as well. So let's look at a couple examples here. This will be fun. What we're going to start out with is the price quote example we started with some actual numbers here. And we can pull up an illustration too, if appropriate. But what we've got here is on the left, a policy on a 10-year-old individual, where we just said, hey, let's shop for a $1 million death benefit. How much will it cost me? Just what's the premium if I want $1 million of coverage on my 10-year-old? Almost no one we work with does this, but this is a common approach in the industry. So based on the product we ran here, the underlying premium is about $7,300 per year. That buys him a $1 million death benefit. And look at that cash value in the first year. Who wants that? I pay in $7,300 and that's my cash value, $250. If I could not pay the premium the next year, or if it lapsed, I would lose the money I had paid in. If I continue to make those premium payments, eventually what happens? Based on the company's present dividend interest rate, so if things do not change and if dividends don't go down, by year 14, when my 10-year-old is 23 years old, I will have broken even, meaning I've paid in $102,000 and I have $102,000. Not that attractive. Example on the right or in the middle, 30-year-old individual, same $1 million policy, costs me more than $7,300, almost $14,000 here. So I'm 20 years older, the cost is higher. Almost 14 grand, $480 right off the bat. Look at the break-even point. Very similar, 13 years in this example. I'll add something here, which we're going to hit on later. This, the 10-year-old, is run at a standard non-smoker. There's rating limitations with individuals. This is run at Preferred Plus for a healthy 30-year-old individual, fully underwritten. But break-even point still a very, very long time. And then the 60-year-old individual, look at this, for the same $1 million policy, $44,000 per year. 15 years just to break even. Now, I would never recommend a policy like this because you're going to see shortly there's ways to really, really make things look better from a cash value and flexibility standpoint. What this validates, however, is if one is just price quoting a policy, how much does it cost me? The older I grow, the more expensive it gets, like any type of life insurance, regardless of what the product is, term, universal life, whole life, whatever. Now, let's look at a similar example here. So going back to the Word doc, first we wanted to hit what it would look like if we just price quote. Number two, what if we said, well, let me just pay a $10,000 base premium. How much life insurance will that get me? So we can price quote, or we can come in and say, here's how much I'd like to pay in. What do we see here? 10-year-old individual, $10,000 base premium, 30-year-old individual, same $10,000 base premium, and the 60-year-old individual, same $10,000 base premium. What do you notice here? How about the first year cash value? Is there much of a difference there? Exact same policies, all a clean $10,000 base premium. Almost no difference in cash value, $342, $347, and $365. In fact, if we take a look at the design here, let's just validate it, because if I'm watching this and I've been presented policies before, I likely have not seen them on Excel. I probably just saw an illustration. So let's take a look at the 10-year-old. Here we go. There we go. Cool. $10,000 per year going in. Where is the money going? One of the most important questions you can ask anytime you're considering a high cash value policy, because where can the money go? Going back to the policy design, money can go toward the insurance premium or toward that PUA rider. Do we see anything in the PUA rider here? Goose egg. This is just, I'm going to give you, insurance company, a $10,000 premium for my 10-year-old child, and that $10,000 premium buys him $1,370,000 in total life insurance. There's the cash value. This will match the Excel spreadsheet. Same thing if we were to look at any of the other examples as well. There's the 60-year-old individual. The first year cash value on the Excel chart was 365. There's the death benefit of 225 and change. There we go. So we just imported everything from the detailed illustrations over to Excel. So as we take a look at this, what do we have? Same 10K per year, breaking even 14 years, 13 years, 17 years. It's a long time. So these two examples, the price quote for $1 million, and then I give you $10,000. How much life insurance does that get me? Is not the best approach. What we want to make sure of is, if we're working with an agent, is, hey, if I'm giving you $10,000 per year, I'm going to add a zero onto it next, but I'm giving you a dollar amount. Is the policy designed properly? If you want to be more specific, is it designed for maximum cash value? Is the premium as low as the insurance company and IRS will allow me to put it? So back to the Word document, we hit the price quote option, hit the $10,000 base premium. Let's look at maximum cash value. So we're going to look at some big numbers here. I'm also going to shorten the funding period, because this is hitting Guardian's sweet spot. What do you notice here? How much are we paying into each policy? In blue, annual outlay, $100K per year for 5 years, total of $500,000. We can take a zero off and make it 50,000 total if it's 10K per year. But keeping all things equal here, total of $500,000 is going into each of these policies over 5 years. Where is the money going? Because again, it can go where? Toward the insurance premium or toward that PUA rider. In fact, let's take a look here. Take a look at the maximum cash value examples, because this will tell us exactly where the money's going. Let's begin with the 10-year-old. There we go. Where's my money? Premium up top. PUA rider is actually right here. There I go. PUA stands for paid up additions. 90,000. So we've got the premium driven down to 10% of the total desired payment each year. So I stated in that manner for a reason. I said total desired payment. If this is your policy, do you think that you have to pay in $100,000 per year? If you get this, you sign on the dotted line, this illustration says 100 grand per year. Does that mean, does this mean that I have to pay that amount in each year and we're going to be billed for it? The answer is no. You can easily design it where I'm committed just to the minimum premium, be that plus the term insurance rider. So if I just round that up, it's a little over 11K. Let's call it 12K per year. And then at discretion, I can add additional funds up to a total of 100K per year. But again, I'm not required to pay that in, making the policy a flexible savings asset instead of a boring bill. Now, let's get back to the design here. Sometimes I ramble on about this stuff. Here's my PUA piece, total payment of $100,000 per year. 100K per year going in. There's my cash value, break even point, clean year 5 in this example. Let's say we're going to look at a 30-year-old individual instead. Same product, same everything here, same design. So we're saying I'm going to pay X amount of dollars into a policy, in this case, $100,000, instead of being told how much it costs. Check this out. Premium, PUA, 100 for 5 years. There's your cash value right off the bat. Death benefit, much, much less. We'll hit on why in a second. And we've got the 60-year-old individual as well. So back to the Excel sheet. What do you notice about these examples? How about the cash value right off the bat? You're paying the same dollar amount in, right? If you're watching this and you're 30 years old or 60 years old and have considered taking a policy out on a child or grandchild, this may provide some additional insight here. Cash value, look at that. Very similar right off the bat. There will be a slight difference. The younger I am, you will see slightly stronger internal rates of return, a little bit stronger overall cash performance. But for the most part, not a huge difference on the cash value. How about the break-even point? Look at that. Just about there for the 60-year-old individual. What is much different? Death benefit. Big, big difference on the death benefit. Now, on these examples, we are assuming that the individual we're working with states something that we hear quite a bit. And that statement is, I don't really care about the death benefit, or it's not my top priority right now when I look at the policy. So we do hear this quite a bit. Hey, I'm interested in a policy, but my goal as the consumer, the person putting money into a policy, is to maximize the cash value first, because that's money that's on my personal balance sheet, or it's for my company on my literal balance sheet for my company. I can access it anytime I want. It gets to work. It goes to work for me, and the death benefit's great. But having access to that money, that's the important piece. So maximizing the cash value first is very, very important. Now, what we want to look at here, so we've got here the death benefit. So how much life insurance can a child have? Well, the death benefit has a direct relationship to the overall MEC limit, how much death benefit that should say. So life insurance, what's the third core benefit when we look at it? First two, safe, second, liquid, and then the third one, tax-free. Tax-free if I do everything properly. So going back to this guy, policy design, money can go where? Toward the insurance premium or the PUA piece. When I pay money into a policy, or I should say this, a question I received years ago was, I don't care about the death benefit, Steve. Can I just pay 0% of my money toward the premium and everything into the paid up additions rider to really juice that cash value? And the answer is no. I wish, but we cannot, because we have limits to be aware of. One, we've got the IRS limit, the insurance company limits. All companies have different limitations. And then two, we've got the IRS limits. So the third core benefit to a life insurance policy is that the cash value is tax-free unless we trigger a taxable event. One example of a taxable event is a life insurance policy becoming classified as what is called a MEC. This stands for Modified Endowment Contract. If your policy becomes classified as a MEC, the cash value grows tax deferred, but anything you access, one, you have to pay ordinary income tax. It's only on the gains, so not your cost basis, but income tax on the gains. And if we touch it prior to age 59 and a half, we have to deal with a 10% penalty tax as well. In short, we don't want that. It strips a lot of the benefits, a lot of the attractive features to a cash value life insurance policy. So here's the fun part. every policy has what is called a MEC limit, which is exactly what it sounds like. It's a limit that determines the maximum, it's a limit that determines the maximum dollar amount I can pay into a policy per year and still have these guys classify my policy as life insurance and reap the tax benefits that I'm attracted to, and not a modified endowment contract, which is therefore taxable. With the MEC limit, how we set it is as follows. It has a direct relationship to an individual's age and total death benefit. There's two other factors, which is individual's gender and guaranteed rate as well, which we'll touch on as we progress through this, but an individual's age and total amount of life insurance. Generally speaking, what you will see, the older I grow, or the older I am, the less life insurance I need to obtain the same MEC limit. The older I am, the less life insurance I need to attain the same MEC limit. Example, if I want a $100,000 MEC limit for a 60-year-old individual, I need just about $1.2 million in total life insurance. For a 10-year-old, for that same $100,000 MEC limit, I'm much younger, so I need more than 1.2. I actually need well north of $4 million. And we're going to touch on how that can be even problematic trying to qualify for that much as well. But main thing, the older I grow, the less life insurance I need to attain the same MEC limit. Let's continue on. So to wrap up actually with this guy, cash value, break even, year 5 across the board, or age 60, just about year 5, and there's your death benefits. So all of these policies were designed for a minimum death benefit and $100,000 MEC limit. So what this represents here for a 60-year-old individual is if I want the ability to pay $100K per year into a policy, I need $1.2 million, $1,210,000 in death benefit. If I'm 60 and have a grandchild who's 10 years old, if I want to be able to pay that $100,000 per year into a policy, I need over $4.5 million of life insurance on him to attain that MEC limit, which can be challenging to get that unless the parents have a lot of life insurance, which we'll hit on next. So here we go. How much life insurance can a child have? Most companies, not all, but most life insurance companies will limit how much death benefit a child can have, and the standard limit is as follows. Whatever the parent has, a child can attain a maximum of 50% of that dollar amount. So we've got the example here. If a parent has $1 million in life insurance, a child can be approved for a maximum of $500,000 in total life insurance. Now, what I'll add here, some additional information, is if a parent has a $1 million term policy and then another $500,000 in group coverage through work, group coverage can be factored in. Insurance companies will often look at that. So the underwriter at an insurance company would say, okay, you've got $1 million in coverage, plus you have another $500,000 in coverage at work, so a total of $1.5 million, which would allow you to now raise the limit on your child's policy to a total of $750,000. That could be one policy, or it could be multiple policies if you gradually get more over time. Now, we hit on this point, the MEC limit has a direct relationship to the death benefit on a policy. The less the younger an individual is, the less MEC space I get for the same death benefit. Let's go back to an example here, actually. Remember that price quote example? A great example of what not to do. So, 10-year-old individual, $1 million death benefit. What's the MEC limit there? You may have noticed this the first time around. We've got it right here. $22,000. Now, for the same $1 million death benefit over here, the 30-year-old individual has a $38,000 MEC limit. And the 60-year-old individual, $83,000 MEC limit. The premiums are ridiculously high here. If a 30-year-old individual wanted $1 million death benefit and they wanted to maximize the cash value, we would actually blend the policy with a term rider. We'd set that minimum premium at about $3,800, which would also be his commitment. And then he could plow the additional funds up to $38K per year into PUAs, hyper-growing the cash value, a lot like the $100K per year example you saw. But what this demonstrates here is that $1 million death benefit for a 30-year-old individual gives you close to 40K in MEC space, 38. But you'll also notice the older I grow, same death benefit gives me more MEC space. Younger I am, same death benefit gives me less MEC space. Very easy stuff to follow, right? Good old life insurance. They make things easy. So a couple side notes here. We've got additional information below. Some companies do allow you to go a bit higher than 50% as far as the total amount of life insurance a child can attain. Limits can go above the 50%, even well above 100% due to or in scenarios where exceptions are granted. One classic example is if the parents or even grandparents want a policy on themselves, but they can't get it. And the reason why is they have a health issue. So say you've got a parent, say you are a parent, you want to fund a policy with 10 grand per year, any dollar amount, but you're declined. Or maybe you're approved, but at an unfavorable rating. Maybe it's a class rating, there's an extra charge, and you look at it and say, man, the price is excessively high. The cash value does not look good, even if I design it properly, because I've got a health issue. What are some alternatives? Well, what one can do is take a policy on their child. We would explain to the insurance carrier that, hey, the parent has an issue over here. They've got a health issue. So the reason why we're applying for a larger policy on the child or children is due to the parent's health issue. And in those particular cases, or many of those cases, we've been able to raise the limit as far as the total death benefit on a child, which also raises the MEC limit. And now the parents have a permission slip to pay more money into a policy. So there are exceptions there. But generally speaking, if we're looking at a policy on a minor compared to a parent, once we look at the numbers, a lot of times a parent will take a policy out on themselves. This way, they've also got the life insurance on them as well, and then we can hypergrow the cash value too. Let's continue on here. There we go. Okay, so point number 4, maximizing policy based on the limits that an insurance company offers. We're going to look at MassMutual next. We are going to focus just on a 10-year-old individual. What we're going to assume here is that you have a 10-year-old son. You've got $1 million life insurance on you as the parent, and the maximum you can apply for them, or a maximum they will be approved for, is $500,000. Now, typically in a case like this, the parent will state, I'm doing this for the cash value. I don't need life insurance on my child. I'm not dependent on my child, and I'm not planning on them dying anytime soon. I'm interested in the cash value. Either I want to use it personally as the parent, or I want to set them up nicely for the future so they can use this down the road. So again, often parents will state, I don't care about the death benefit. Why can't I pay more money in? Well, the reason why, going back to those MEC limits, remember what has a direct relationship to the MEC limit? Total death benefit on a life insurance policy. So here we go. How much money can I contribute to a policy based on the death benefit and total MEC limit? Awareness is a good thing to be aware of, or a good question to ask your agent. Guaranteed rates. Different life insurance products have different guaranteed rates. If we would have done this webinar last year, it would not have been the case, because we had a 4% guaranteed rate across the board. Since the 7702 change, where all life insurance carriers can select different guaranteed rates for different whole life insurance products, what that has resulted in is the lower the guaranteed rate is, the greater the MEC limit is for the same death benefit. We're going to look at some examples. I know it can be a little bit confusing, but it is great to be aware of this. So let's look at a $500,000 policy, but we're going to look at different products with the same $500,000. So $500K life insurance policy with a couple different products here. What we will begin with. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.